What's up, family? Welcome to another Food and Finance Fridays on Lyle's Legacy. Now, in these different videos, I talk about using strategies, and in particular, strategies concerning life insurance. Okay, so what do I mean when I say strategies? In this video, I'm going to cover a few basic strategies, not go on them in detail, touch on some highlights. So you can think about what type of strategies can best fit your needs, your wants, as well as your budget. All right. Um, Before I get all the way into that, I want to talk a little bit about this bok choy mushroom soup. Okay. Now I got the pretty much the procedure. I can't say the exact recipe, but I got the basics for this off of a channel called The New Vegan. I believe information will be in the description below, along with a link to the video. Okay, but in here, I marinated portobello mushroom slices in coconut aminos, apple cider vinegar, garlic powder, um, onion powder, oregano, and smokehouse maple seasoning. After I did that, I sauteed onions in low sodium veggie broth. Then I added in the mushrooms and the bok choy after I had cut the bok choy up, including the leaves. All right, that's important. So I added all that in there. Then a full carton of low sodium veggie broth. And then I seasoned it with ginger powder, black peppercorn, garlic powder, chili powder, and turmeric powder. Okay. Now, when I was adding the ginger, I was telling my wife, I don't want to, add too much ginger because ginger is really strong. But then what did I do? I added too much ginger. Then I had to compensate, for the ginger that I added, adding some of the other seasonings, which it actually turned out to be a happy little accident. All right. So I want to go ahead and taste it. Now, my wife loved it. My oldest daughter loved it. My second daughter, she loved the broth, not so much the contents. My youngest daughter liked it. Now, let me check it out for myself. It's making my mouth happy. mm. I'm so glad I did that. So, now this is a happy little accident with food. But what if there's an accident with finances, right? You know, are you able to get back on track? Of course you can. So, let's say for instance that you have a negative margin. Of course, first thing, I would recommend is that you look at what you're spending every month, okay? Even every week. Cut back, wherever it's possible, wherever you see where you're spending money unnecessarily. Because if you're at a negative margin, you really don't have margin, right, for unnecessary spending. Then find creative ways to make extra money. Maybe even starting a business that has like a low cost startup, but great income potential, such as financial services business. All right. Um, Now, sometimes simply cutting back will create the margin that you need. But once you've done some cutting back, you started making money, you also want to put in place financial tools that, such as life insurance, that can help protect against, financial threats, such as getting sick or injured in such a way that you are not able to work and make money. Okay. All right. So some of the strategies that I'm going to talk about, just a few of them, the basic strategies. The first one is having a mortgage protection plus lifetime protection. Okay, so what do I mean by that? Well, when I say mortgage protection, I'm talking about a term policy. All right, for let's say you have a 30-year mortgage, so then you want to have a 30-year term. Okay, let's say your mortgage is $300,000. All right, so now getting a term policy for $300,000 is a lot more cost effective than getting a permanent policy for $300,000. Now, are there times that I definitely would recommend that for sure, but not for this. Okay. Now they even have some term that where it's a decreasing term. Now with that, as your mortgage decreases, it's calculated so that your insurance, the life insurance that you have, will decrease as the mortgage is decreasing. Okay, that might be the way you want to go. It may not be. All right, that's just one of the options. Now I said plus lifetime protection. So what is that? Okay, that's a permanent policy. So you know, let's say you have a $200,000 permanent policy. Okay, so that's a total of 500,000 $500,000 of coverage. Okay, so but that 300,000, that's a 30-year term, that will someday fall off. Now, of course, you could renew it. Let's say you're young enough. Um, Once again, there are also term policies that you can convert to permanent. You may not necessarily want to because you may be overinsured if you keep all of that. Maybe not. Okay. Um, but that permanent policy, the benefit of having that is it protects you for your life. Okay. So once again, term insurance is for if you die. Uh, Permanent life insurance is for when you die. Okay. It takes you through your life. So that's one strategy. There's another that is actually using a term policy, okay? So let's say you get a 30-year term policy, but with this, it's a return of premium, okay? Usually with term insurance, it's like if you don't use it, you lose it, right? Well, there's a particular term policy that at the end of the 30 years, you have two options. Okay? You can either get a return of your premium in cash, or you can use the cash that has accumulated in within your premium to use it paid up for an additional 15 years. So instead of having a 30-year term, you end up with a 45-year term. It's pretty cool. But what if you want to use that money for something? Okay, what if you want to just use some of it to supplement either a little bit of your retirement? You want to use it for vacation? What if you need it for a surgery or anything? Okay, that's where the return of premium is a game winner. It's really a game changer. Okay, all right, so there's that, the mortgage protection term policy plus the lifetime protection permanent policy, either with an IUL or a whole life. Okay, you got the return of premium that I talked about. That's a term policy. Now, here's one specifically for parents. All right, when it comes to saving up money for college, what's the best place to save it? Okay, Is it in is it in your savings account, in checking account, where you're really not going to get a great return on that. Yeah, it's pretty much safe, yes, but then you're pretty much going to have to save dollar for dollar, all right? Whatever it is that your college tuition is going to be, whether it's a 4 year college, a trade school, or whatever, okay? So, of course, we encourage children to apply for scholarships to do their part. If they want to continue their education in one way or another, they need to do their part, right? But as parents, we want to provide for our children, okay? So you can use your own life insurance policy to fund for your child, okay? So the earlier the better. So let's say your child is, let's say, 3 years old, okay? And you have a life insurance policy, okay? That gives you, what, 15 years. 15 years before that child potentially goes off to college. What you can do is you can overfund that policy. It's an IUL. It's not tied to the stock market, but it mirrors the stock market when you because it uses an index. Okay, so as the market goes up, the cash value goes up. It grows. It grows. But the beautiful thing about it is you can't lose your money, right? Because it has a floor. You can't lose your money based on stock market going down. All right. So as you're overfunding it and it's growing, when the market goes down, there's that floor. So your account stays level. All right. Of course, it's going to grow some as you put more premium in it. Okay. Just because you're putting more money into it. But as the stock market goes back up, boom, all right, your cash value continues to climb, all right, and it gets a new floor and a new lock in each time. So that's the beautiful thing about it. Now, here's a way to think about it. Now, when you've saved up money in this account to use for your child's education, after your child finishes, you can either have that child, pay you back in installments so you can help to refund your account, all right, and prepare for your retirement, okay, or you can just, do it simply as a gift, okay, because here's the thing, they can repay you, all right, when they're not paying interest, okay, or they could take out loans and owe Sally Mae or whoever, a lot more money than they even took out, and then what they're making in most cases. All right, and why would you have them do that? All right, so Lyles, why are you saying life insurance? Why not a 529 plan? Well, I am not against the 529 plan. So the 529 plan does have benefits, okay? So one, as long as it's used for your child's education, it is tax-free. All right? One thing about it is, here's some of the drawbacks. You are able to lose money in that account. And two, and if you don't use the money for the child's education, whatever else is used for, they're taxed. Okay? With this plan I'm talking about with the life insurance, it's tax free. It's not even, as of right now, it's not counted on the FAFSA. That's where the 529 plan will be. So there's certain grants and other monies that they may be able to get through FAFSA that they won't be able to get if you use the 529 plan that you can get if you're using the life insurance. All right. Now, in my opinion, one of the greatest things that you could do for your child, for your kids financially, is get them a policy with great growth potential. When of course, when they are kids, when they the earliest you can get right now, until the rules change, is when they're 2 weeks old, right? So when they're 2 weeks old, they're not going to be any younger or healthier in most cases than they are then. So it's definitely going to be the cheapest. You can use that. Of course, you're funding it, right? And as they grow, you teach them the power of what it is that they have. And when they get old enough, you have them start contributing to it so that they're in the habit of it. As they grow older, okay, they're in the habit of it. It's a very good habit that they have. And then they, pardon me, very good habit that they have. And when they get, let's say they reach their retirement years, whatever they want to count as retirement, they could potentially have, saved up in the cash value and as well as in the distribution, millions of dollars that they can receive tax free in the retirement years. Okay, now it'll be over the course of years that they won't just receive it all at once. Now we could talk about how that works and everything, but yeah, it can potentially be millions of dollars. All right, and then they're doing the same thing for their children. Now they're passing on generational wealth. And of course, when they die, there's a death benefit. It gets left in the family. All right, so those are just a few things that I want to share. Those are a few basic strategies. There are more strategies and more advanced strategies that I strongly encourage and recommend that you speak with financial professionals who can help you with a strategy that fits your needs, your wants, and your budget. And of course, you feel free to contact me either by email at loudslegacy22@gmail.com or by phone at 330-319-0141. All right. Of course, that'll be in the description. Family, I hope that this was helpful, that you got something for it. Go ahead and like the video, subscribe, comment, share, and hit the notification bell so you'll be notified anytime that I upload a new video. Remember to take control of your time, your finances, and your future. I'm out.